how to make property cash in a market crash. Bit of a tongue tie there, but the important thing when you go into any uncertain times in an economy is building out your wealth. There's more opportunity made, more millionaires made and in any other time than there is in a recession. But what strategy do you do? You've got buy to lets, you've got SAs, you've got service accommodation, you've got purchase lease options, you've got rent to rent, you've got commercial conversions, you've got developments, you've got tons and tons and tons and tons of different strategies out there. So what is the right strategy for you? So make sure you watch this video to the end, because I'm going to share with you a little bonus at the end, but also I'm going to share with you what strategy is right for you. And there's a different strategy for all of us, depending where you are in your journey. But the first strategy that you can do is hit that like button. That is going to get you massive thank you from me. At the moment, there's loads and loads of news. We've got CNBC saying a tragedy. Britain's cost of living crisis worsens as rents soar and energy bills top $5,000. You got Forbes saying recession is coming. We've got The Guardian saying the Bank of England will probably need to raise rates again. You've got The Guardian saying also UK inflation hits 9.1%, a 40% high. You've got Ukraine and Russia conflict in the Times. You've got ORF saying clash of China and US over Taiwan. We've got Yahoo talking about the FTSE lagging. You've got stock markets in general lagging, and not to forget about the crypto market absolutely tanking, and loads of concerns. Property market took its first minor dip, 0.1%, only a minor one at the moment. So what do you do when you're going into recession and hard times? One thing you've got to remember is since the Great Recession, there's only been two, like you get corrections and you get major recessions. And with the house prices, there's been only two not recessions, corrections and crashes. And a correction is just a slight correction. A crash is when it majorly drops. We've only had two major crashes in the property market in all the recessions we've had since the Great Depression in the 1930s. Because property is a safe haven. Look, like this, look, I buy gold all the time, not just because we're going into crash. I just like gold. I think it's a safe saving bet. And I bought these couple of coins. My friend's a trader, and I buy these coins all the time just as an asset class. The reason I like property over these coins is because them coins don't pay me a monthly recurring income, and cash is king when you go into a recessionary time. So as long as you fix for 5 years at the moment and you've got a strong cash flow, it doesn't matter what the asset price does if it fluctuates up or down. This is what's going to give you through this cost of living. This is what's going to make you thrive through this, as long as you've got the cash flow coming in. So cash flow is king. It's what pays for your holidays, what pays for your cars, what pays for your increased cost of living. And property gives you the best cash flow. It's really safe. The reason the property is not crashed loads of times is because it doesn't usually crash, or always crash in market recessions, in market downturns and economic downturns, is because it's a safe bet for investors. A lot of money comes into gold, into property when we've got downturns. The reason it didn't last time is because it was the mortgage market crisis and the banks lending irresponsibly on mortgages. This time that's not happened, so the likelihood of properties majorly crashing this time is a lot lower, and that's all the consensus going towards that. I'm not going to go too deep in that. Talk about this on this video here if you want to go more into that. But we've already established now that property is a great wealth builder through ups and downs, but it's getting that right style property. If you get properties that's covered by housing benefits, so if your tenant loses their job, this gives you safety through a recession. But all the strategies work, like all the different ones. Look, I talk about the property delta matrix. If you've not seen me talk about this already, definitely check out this video where I go into more depth. We're going to cover this a little bit here, the delta matrix. That video, you see me actually going on patch and showing you these style properties. But I talk about, look, you need to make any successful business, not just property business work. You need money, you need knowledge, you need network. And then sitting right in the middle of this, you need time. This is what a lot of people underestimate. No matter how much money you've got, if you've not got time to implement what you know and how much knowledge you've got, if you've not got the time to implement that, it's not going to get you anywhere. But there's different strategy. Look, these are the main wealth building strategies. We're not going to talk about rent to rents and PLOs and deal sourcing right now. We might mention a little bit more of that in a minute, but for the time being, we're going to talk about wealth building in property and creating recurring income, because as I said, cash flow is king in these times. You want solid recurring income. So you've got at the bottom here, you've got your buy to lets. Just above that, you've got HMOs and SAs. And as you go further up, it gets more complex and more riskier. You've got then commercial conversions and developments. And you can blend these into purchase lease option and all these different strategies there, but this is your foundation thing. This is how you build it out. And you think to yourself, where do I start? What strategy do I start on? And do I do them all? If you do all of them, you're burnt out. I tried doing loads of strategy. I tried building a building company. I tried building a deal sourcing company, a lettings company, my own portfolio, and multiple things at the same time. And the Chinese proverb says, you chase two rabbits, you get none. So this is a great thing I learned early doors from Progressive Property when I started doing my early trainings, was the 70, 20, 10 formula. And basically what this is 70% should be on your main strategy, 20 on your secondary, and 10 on your third. And what happens is, once you then, because when you learn a new strategy, it takes up a lot of mind space and it takes a bit of time to put systems in place to automate it. But once you've got it automated, you move this over into your automated place, and then you move your 10 up into here, and then you move a new one in over here. So this is how you build multiple streams of income via property. And what you want to do is build out a solid portfolio. As I said, check out that video I suggested earlier on. They'll be along the bottom of these videos as well, so you don't have to watch them now and jump to them. They'll be in the description if you don't want to jump straight off now. But check out that video about these different, I'll show you on patch the different style properties that I'm actually going to visit and where they are. Because in the property, like certain ones will give you more downside protection and certain ones give you higher profits. Look, SA's really collapsed when we hit COVID. You don't know what's going to happen in the market, these things. HMO's a little bit more risky. There's a lot more coming in. Cost of living, the energy bills, everything going up is going to affect these. Unless you've got really strong margin on these, this could really, really affect these strategies. Commercial conversions, the thing with commercial conversions, they're great once they're developed out, but if you're doing one and you're halfway through it, I know some developers, they got halfway through a development at the start of COVID, but luckily you had a lot of experience and networks, so they managed to raise the money, private finance. Development's a lot riskier, especially if you've got to get planning. From now in 3 years' time, inflation could have gone up, cost of labour could have gone up, cost of materials could have gone up, prices could have gone down. So it's a lot more riskier. But if you've got a solid foundation underneath it to go for this is where some bigger rewards are. But make sure you've got the downside protection. Always manage the downsides. What I mean by manage the downside is, can you afford the worst case scenario? If you do hit headwinds, builders can go bust in recessions, builders can just mess you around, builders can do a bad job. You get headwinds. When you get more experience, it doesn't mean you're going to eliminate headwinds. What it means is you navigate them quicker. So, but you want to have the income to support that. So what strategy do you start with? Well, let's think about income. If you've got a solid foundation of buy-to-lets, let's say you build up 5 buy-to-lets and they give you roughly $250 each, you're going to have £1,250 here for your buy-to-lets. What this does is, if you do HMO like all en suite, you need to do bigger developments like 70, 80, 100 plus K developments. So if you've got bridging or development finance on that, it's costing you like £1,500, £2,000 a month. You want to have a little bit of stability, or maybe it's costing you £1,000 a month on your first one. You want to have a little bit of stability in your income to support when you do hit these headwinds, because you will hit them. I've just done a project and hit loads of headwinds, and it took me a lot longer. It took me double the time I hoped. It cost me about 20K more than I hoped. But because I've got a solid thing under here, I've got more than this. I've got a solid portfolio and diverse one. It support me through it. But look, if you do go into this, you get development finance, which is a K a month. This then to take on the more complex stuff. And once you've done 5 of these, if you've done 5 times these, built up a bit of courage and confidence to go up to the next level. And at the next level, you might do then 6 HMOs. But in the meantime, you still might buy an extra 2 more of these, 1 more of these, or 2 more of these. It takes you up to 1750. So you can wipe that out, it takes you up to 1750. You bought 2 more of these and 6 of these. And say the HMOs, 6 HMOs and SAs, and they give you roughly a K each. You then got a 6K income. So then, when you jump up to the commercial conversions, again, even more complex, longer builds, more challenges along the ways, more potential risk that goes on. You've got then nearly 8K, just shy of 8K, 7,750 to support you out if you come across so many headwinds. And let's say then you come over here and you do 2 commercial conversions, and you get 2K per property, and you get 4K from this. You're now dragging in over, like you get just shy of 12k you're dragging in. So if you did want to ascend up into this major point up the top here, you've got a decent income to support you out when these things and challenges do turn up, because they do turn up. But where do you start? How do you know where to start? I believe most people should start on buy-to-lets, but there's always exceptions to the rule. When Anthony Joshua won the Olympics, he didn't go straight in for a heavyweight equivalent to this. He fought journeymans, big arenas, got his skill and got his confidence up. So how you figure out which strategy you do, let's mark all these off. Let's say you've got your money, you've got your knowledge, you've got your network, you've got your time. And down here, I'm going to put this one in. This is confidence and conviction. If you've got no courage, confidence, conviction, you need to build it up. James Clear wrote a great book called Autonomic Habits. He said the most reason people don't get forward is because overthinking, just they haven't got the courage and confidence to convict. But conviction is a momentum game. They say the hardest weight you'll lift in the gym is the front door. Once you get in there and you've done that, you gain momentum. So he talks about the 2-minute rule and starting small and building up on it. Same as what I talked about with Anthony Joshua, building up his confidence and courage. If you go too high too quick and you mess up, it's going to really destroy your confidence. When you go higher up and you've got this foundation and you've got experience, you just learn. It's part of the journey, so it doesn't destroy your confidence like it does when you're first starting out. So you need to measure yourself from 0 to 10. Where do you stand on all of these? So with your money, with your knowledge is also experience. You could have a lot of knowledge by watching the YouTube, which is great. You can have a lot of knowledge by going to read books and getting some training, but knowledge also comes with experience, delivering that, going through it, like seeing the little teething problems that you occur along the way. You could, your network, and as I said, your time, which is an important one. You get a lot of people, because they get a lot of knowledge, network, and some money availabilities, and they're squeezed on time and they take on too much, like I explained earlier on, and the wheels fall off. So what you want to do is mark yourself from 0 to 10. There is exception to the rule. You might be a building, you can jump up here. It's not so overwhelming. You've got experience, you've got vicarious skills that you can carry across, transferable skills, that you can transfer across to do some of these bigger projects. But most people want to start here. Also, this gives you a solid income. This gives you credibility with the banks. A lot of banks will not start lending you bigger stuff if you've got no experience. So you start that experience, that level 1 computer game, you can skill up from now. But again, you ask yourself just these questions. Where am I at in the journey? How much money have I got? Like, look, if you've got 50k and you're investing in the North East, you're probably here. But if you're investing in London, you're probably more like here, 0.4, because you're not going to get very far with 50k in London. And again, knowledge-wise, you've got to compare that to the skill you've got. Network's important, because if you want to do developments, you need planning consultants, you need tax advisors, you need architects, you need a big network, the right solicitors, the right brokers. You need a really, really sturdy network. So as you start doing these smaller ones, you slowly build out a network of builders, accountants, and build out your credibility, and again, importantly, your confidence. But that said, look, if you're high up here on confidence and conviction, and you accept that, look, things will go wrong, but I'm happy to pay, like, I'd rather pay money for speed, and you've got a lot of money, you might go further up. But I know a lot of people with a lot of money, and they're just cautious. They're down here on courage and confidence. So they have to just start. You want to start here. The thing is, high yielding single let properties at low purchase prices is the foundation of this. But it don't work in the south. So if you're like me and you live in the south, you need to think about Wales or the north and these areas that you can buy under 150k with high yields. That is the real sturdy part of that. If you put these on 5-year fixes with family homes, you're pretty safe. And if they're covered by housing benefits and people lose their jobs, you're in a pretty safe place. If you've got high level properties that are like, say in London, £1,800 a month and the housing benefits is only £1,000 a month, if you start losing a few tenants, you can soon get squeezed really, really quickly. But that said, I've talked about the all-weather portfolio. As I said, there's a suggestion, maybe watch this video also to go a bit more in depth on that. I'll talk about the all-weather portfolio, but this is what it is. This is my portfolio here, and this is an all-weather portfolio. Ray Dalio talks about this in the stocks, but you want a diverse portfolio. So I've got buy-to-lets over here, which is your foundation. Then I've got some HMOs over here, but these are split up. So I've got some social housing HMOs and some higher end ones and just normal ones. Then got SA and then commercial conversion. Commercial conversions are great once they're developed out, but it's taking them on in uncertain times if banks recall you. It's getting them developed out in time before things can potentially go wrong. But over here as well, you look this off, I've got professional higher end single lets, and I've got lower end ones. So this creates me a diverse portfolio. Look, this stuff here and my social housing, let's put SH here, and this stuff over here, I've got some social housing in this section here, which are on guaranteed rents for 5 and 10 years. Is the sturdy base. So look, if I've got a higher end HMO and people start losing a job or feel the squeeze of cost of living, they might go, look, I don't want to live in this ensuite one. I'm just going to go and live in the one that's £200 a month cheaper because it's not got an ensuite and not this co-living place. SAs, people might not travel so much and this could get hit, or if jobs and big construction start slowing down, things like that could be hit with the SAs. As I said, commercial conversion good once you've got them developed out, but halfway through you've got to look at the risk of developing that. So buy to let and single let low purchase price is the real foundation of that. So you want to build out this diverse portfolio. And again, this is how you measure whether you can do it. So you've got a bit of time, you've got a little bit of time spare, and you've got an okay bit of confidence. What you might do then is look at like being a deal trader, like packaging deals. Because what you can then do is you don't have to have as much experience as long as you work with it, you package your deals onto experienced people. You can then learn from them as you're packaging them on, and you can we typically sell these deals for about 5.5k because we trade deals. Anybody interested in that, reach out to us. Anybody interested in management in our area, I'm in the northeast, reach out to us on that as well. We've got lettings and a company that sources you and manages the lettings for you. If you're interested in that, reach out to us. But off the back of that, you might then think to yourself, okay, you've packaged 3 of these or 4 of these. After all my costs, I've packaged 4 of these and I've got 20k in the bank. And that now allows me to go and buy one of these solid 100k properties or 70k properties, depending on where you are and what cash you've got. That gives you the deposit towards that and gets you that momentum going. You might then start, once you've got a bit of momentum, think of other people's money and JVs. Obviously, be really wary of lending other people's money in this market climate, because if you can't, you've got to think about paying them back. You've got to be able to think about refinancing that to be able to pay them back. In this sort of climate, banks lend very cautiously. So you've got to think, can I refinance enough money out to pay them back and pay them back their interest? Or making an arrangement with them to just pay them off in installments. But that's not a video for this here. It's talking about what strategy you should do. But how you pick the strategy you should do is by scoring yourself on these. The higher you score on these, the higher potential you can go up on there, depending on the foundation you've got. If you've got a load of courage, confidence and conviction, that means you've got a great risk profile. It means you can potentially go further up. Some people can do it, but that's not everybody. Don't judge yourself, or find out where your pace is and do what's right for you at your pace. But there's loads of things to factor in. Rate rise, that's why I talk about interest. That's why I talk about fixing it for 5 years. If you fix it for 5 years, you've got strong cash flow. The cash flow is what pays everything. As I say before, said this many times in my videos, it's going to pay for your extra cost of living. It's going to pay for your holidays, your bills. So it doesn't really matter as much what the asset price does, whether it fluctuates up and down, as long as you've got a 5-year fix. And if the rates keep on going up and you're fixed, watch this video if you want to know more about rates. But if you've got a 5-year fix, this is what's going to give you that safety in that. And I really appreciate everybody that's shown me love on this channel. It's starting to get momentum. It's been hard work, but everybody's been loyal and liked it and stayed to the end and watched these. I want to thank you so much. As a thank you, as I said, if anybody says and it gives me a DM asking for a discovery call, I will give you a discovery call. I said there's a free little gift at the end. These discovery calls are worth $350. My mentoring and one-on-one mentoring is £350 an hour. So we'll jump on a call with you and figure out what it is. But just put discovery call in the comments and I'll get back to you and we'll arrange a discovery call absolutely free of charge as a thank you. But listen, my wife's living my terms. My mission is to help as many people live on their terms using financial education, property, mindset as a vehicle to do that. So please help me out on this mission. If you've not done it already, hit that like button, hit the subscribe button and the bell icon so you get notified every time we build these videos out. Please give this a share out if you think somebody will find it useful. And remember, if you don't evolve your ideas, you never live on your own terms. So evolve your ideas, live on your own terms. Have an amazing day.